Hi, this is Colin with Dakota Plains Ag Center in Napa Junction in Greeley, South Dakota. This video will yield 5 minutes of your time. Today we're going to talk about the quote, unquote, funds. Every Friday there's a commitment of traders report that comes out in the afternoon. It looks something like this, and it highlights the managed money on their positions, whether they're long or short in each commodity class. So this week, corn, the funds are short 89,000 contracts of corn. They bought 21,000 contracts this week. The soybeans, they're long 87,000 contracts of soybeans, futures and options, and they sold 13,000 contracts from last week. So, just going to talk about funds today, what they are, why is it important to know this information. Something that traders monitor, the funds can affect the market. So what is a hedge fund? A fund, according to Investopedia, the hedge funds are an alternative investment using pooled funds that employ numerous different strategies to earn an active return for their investors. So in country boy terms, it's capital or money that seeks the best return on investment. So basically the hedge fund manager searches all the asset classes out there available, and he looks for the best one to get the best return. So the investment choices are almost infinite. So they include real estate, stocks, bonds, commodities, futures, options, currencies, etc. So what the manager is looking for again is his best return on his money or his capital. So I have a contact in the industry who works with these hedge funds, and this is one example that he gave me. He said there could be a fund out there that has maybe $100 million available to invest. That fund or that manager may want 3% of his portfolio exposed to the agricultural commodity market. So that'd be $3 million that he wants, to be long combinations of futures and option strategies. So the fund manager may decide to go long or buy $3 million worth of corn futures or options contracts. So my contact told me that the funds typically want to be long commodity exposure, or they want to be bought into the futures instead of sold, meaning they buy the futures contracts. But he said if they have a strong bias, they may be exposed to the short side of the market or the sell side of the market. So classically, a hedge fund is delta neutral on their long and short position. So that means if they're long or bought in one asset, they will typically be short or sold in another asset. So that's why they call them a hedge fund. They're hedged. So why is this important to your farm? This money flow from different asset classes to corn and soybeans and wheat can bring liquidity to the market. It can bring volatility, it can bring opportunity, and it can bring risk. So the money flow may trump some of the fundamentals in the market for any given asset. So with the age of electronic trading and global markets and all the transparency in the market, the money flow can be very fast, and it can affect the market that you're concerned with, corn, beans, and wheat, very rapidly. So on the beginning of the video, check out the graphic that I posted on the video. It highlights the commodity asset performance for 2016, courtesy of visualcapitalist.com. So imagine yourself, when you go back and look, imagine yourself a hedge fund manager trying to get the best return on your money and choosing the best commodity to be exposed to. So we all remember the soybean rally last spring. Pretty big rally, $2.80 rally or something. So that asset class, soybeans, had a 16% return in 2016. And it's kind of middle of the road for commodities, actually, and that's a big move. Check out iron ore. They had 81% return on investment for iron ore, and just think of the volatility there. So this volatility, the opportunity, the risk, in these futures markets that the funds can affect is more of a reason that we need to know, or one, a farm needs to know where they need to make profitable sales and have a plan to pull the trigger when these markets provide a profit. So that is what I've learned about these funds. And by all means, this is not an extensive definition of hedge funds or managed money. It's just something that I've learned, and nothing that's super complicated. So if you didn't catch the previous video, I covered 4 things to consider when setting basis. Thanks for watching. Be safe out there.